All right, let's dive right in. We're looking at a really fascinating puzzle in the market today, a company called Infosys. Now, on one hand, if you just look at the stock chart, it looks like a total disaster. It's screaming, "Get out now!" But on the other hand, if you look at the actual business, well, it looks rock solid, a picture of strength. So what's the real story here? Is this a falling knife you shouldn't touch, or is it a massive opportunity?
And that's exactly the situation we're going to break down. You've got pure market emotion, fear on one side. And on the other, you've got the hard, cold reality of the business. To figure this out, we've got to follow the data, not the noise.
So, first things first, let's look at the side of the story that has investors so spooked. We're just going to look at the price action and see what the market itself is telling us.
And yeah, it's not a pretty picture. The stock has just been hammered, down a whopping 33% in just 1 year. It's gone from a high of around $30 all the way down to about $14.50. That's a 5-year low. This is the kind of free fall that makes people hit the panic button because it's wiped out years and years of gains. But wait a second. This is where the story gets really, really interesting. Because during that exact same time the stock was getting crushed, look at what the business was actually doing. Revenue wasn't going down. It was absolutely exploding. It grew from under $13 billion to over $19 billion. The business is at an all-time high while the stock is hitting a multi-year low. That right there, that is the disconnect we need to understand.
So, okay, let's just ignore the screaming stock chart for a minute. Let's put on our business analyst hats and peel back the layers to see what's really going on with the health of Infosys as a company.
Now, the big worry you'll hear is that their profit margins are getting squeezed. With fears of a recession, maybe companies will slash their IT budgets. And that's true. You can see a little dip here from the peak. But here's the crucial part. Even with that pressure, this company is still incredibly profitable. A net margin over 16% is absolutely elite for a company this big. They are turning a huge slice of their sales into pure profit.
Now, I want you to just look at this number for a second. 47.9%. This right here, this tells you almost everything you need to know about how well this business is run.
It's the company's return on invested capital, or ROIC. And what it means is that for every single dollar the company invests into its operations, it generates almost 48 cents back in profit. I mean, that is just world-class efficiency. And look, it's not a fluke. They've been doing this consistently for years, which is a huge sign that they have a powerful competitive advantage, what a lot of investors call a moat.
Okay, a great business is one thing, but is it built to last? Can it handle a storm? Let's take a look at the balance sheet and see just how strong their financial foundation really is.
And wow, just look at this. The company is a straight-up cash machine. And we're not talking about some fuzzy accounting profit here. This is real, hard cash. Their free cash flow, the actual money left over after running the business, has nearly doubled in 5 years to over $4 billion. This is the fuel they can use for anything they want, investing in growth, paying out dividends, you name it.
That's always the critical question, isn't it? Lots of companies can grow, but they do it by piling on a ton of debt, which is super risky. So what's the catch with Infosys? How much do they owe? The answer is almost nothing at all. This picture right here perfectly shows what we mean by a fortress balance sheet. You've got over $4.3 billion in cash on one side of the scale and less than $700 million in debt on the other. They could pay off every single penny of debt tomorrow and still have billions left over. This is what it means to be net cash positive, and it signifies pretty much zero financial risk.
So how do they pull this off? Well, it's because their business model is just incredibly efficient. They're a services company, so they don't have to spend billions on building factories or on risky R&D. You can see their capital spending is just a tiny little sliver of their revenue. That means almost all the cash that comes in the door just converts directly into that free cash flow we were just looking at. It's a low-maintenance, high-output machine.
So what do they do with all that cash? They give a huge piece of it right back to the owners of the company, the shareholders. Last year alone, they returned over $2.4 billion through dividends and stock buybacks. And at the stock's current low price, that dividend pays you a yield of over 3.5%. You're literally getting paid a nice income just to wait for the market to catch up with reality. All right, so we've established the business is incredibly strong, it's growing, and it's gushing cash. So now, let's connect that all back to that beaten down stock price and talk about valuation. Is it a good deal? This chart shows the price-to-book ratio. It's basically a simple way to see how much you're paying for the company's stuff, its net assets. And you can see the price tag has been slashed by almost 40% in just 3 years.
So think about that. The business itself has gotten bigger and stronger, but the price the market is asking you to pay for it has gotten way, way cheaper.
Okay, let's put it all together right here. This slide just perfectly summarizes that whole conflict we've been talking about. The market story, it's all about a crashing stock and a shrinking valuation. But the business's story, it's about all-time high revenue and cash flow that's almost doubled. I mean, the two stories could not be more different.
So, with these two completely conflicting stories laid out, how do we weigh the evidence? Let's bring it all together and try to reach a verdict.
On one side, you have the bear case, and it's mostly about feelings and perception. Bad stock momentum, some margin pressure, and just this general fear about the economy. But then you look at the bull case, and the evidence here is all about facts and fundamentals. Record revenue, doubled cash flow, elite returns, a net cash position, a generous dividend, and the cheapest valuation in years. When you lay it all out like this, the weight of the evidence really seems to lean one way, doesn't it?
And this quote from the analysis just nails it. It's a classic dislocation. Whenever you see a stock price moving so violently in the opposite direction of a company's actual cash flow, it's a huge signal that something is off. It means perception and reality have become totally disconnected.
And so the final verdict from this whole analysis is that this doesn't look like a falling knife you should be scared of, but a potential generational value play. When you combine that fortress balance sheet, that incredible 47% return on capital, and a 3.5% dividend to pay you while you wait, all at a historically cheap price, it presents a pretty powerful opportunity for anyone who focuses on the business instead of the market noise.
Which really leaves us with one last question to think about. When a fundamentally great company goes on sale like this, you have to ask yourself, is the market seeing some hidden danger that we're all missing, or is it just panicking, and in doing so, giving patient investors a chance to be early? And deciding which one of those stories you believe, well, that's what investing is all about.